before we begin, in the UK, where shares in food delivery service Deliveroo tanked in their market debut, investors shunned the company for asking too high a price, even though it's never made any money. The firm also faces questions over what critics say is the exploitation of underpaid couriers. Paolo Montecillo reports.
Deliveroo demanded a share price of over $5 and a valuation north of $10 billion in its anticipated initial public offering in London. What it got was a disappointing market debut. The company's shares fell as much as 31% before recovering slightly, with its valuation coming in at around $8 billion. That's much lower than its estimates last week of as high as $12 billion.
I think the company probably hasn't done a great job of convincing investors that's appropriate, given the competition that it faces.
The poor reception for its IPO reflects skepticism over its business model. Deliveroo pays couriers to deliver food from restaurants to customers' homes and takes a cut out of every order. Demand for that service has risen during the pandemic. The firm operates across Europe, parts of the Middle East, Asia, Australia, and New Zealand. But it competes with the likes of DoorDash and Uber Eats, and the battle for market share has been costly.
We can see that at the moment between Deliveroo and Uber Eats, there is a war going on the ground. They sent all their troops by putting bonuses to the race, plus €1, plus €2 per race. So all the delivery men go into the street to get the groceries.
Deliveroo opened in 2013 and has yet to make a profit. It lost more than $300 million last year, despite revenues growing 65% to more than $5.5 billion. The company could lose even more after a recent UK High Court decision giving Uber drivers full employment benefits. Investors fear that precedent could eventually cover the entire gig economy.
This is just a big investment risk. Its costs may go up, so it may not make a profit as quickly as we think. But either way, some investors have clearly decided to avoid the shares.
Hundreds of the firm's couriers in the UK are set to go on strike next week to call for better benefits. The company has said meeting those demands would be too expensive and would deliver a financial blow it won't be able to survive. Paolo Montecillo, TRT World.
Now, Susannah Streeter joins me live from Bristol for more on this. She's investment analyst at Hargreaves Landsdown. Welcome to the program. Now, Deliveroo is operating in a very competitive market with the likes of Uber and Just Eat. Can investors expect this company to turn profitable soon?
Well, I think this is the very issue right at the heart of all of this concern about the huge valuation put on Deliveroo as it launched. The very fact that there is a lot of competition within this market. Uber Eats, as you say, Just Eat Takeaway, more established in many ways. And so, of course, there have been concerns that actually, because of this competition, it's going to be difficult for Deliveroo to grow. Deliveroo would argue that it offers something different. It has an additions arm, for example, which actually provides kitchen space for high-end restaurants, and that, it says, will help its growth prospects. But the fact is it's very competitive in this space. You compare, for example, Deliveroo with Airbnb, which also launched at the end of last year to a lot of fanfare. At the same time, DoorDash in the United States also launched, another food delivery company, and DoorDash has seen its share price fall, particularly since a high in February, whereas actually Airbnb has been more resilient because some people would argue, look, it's got a much better USP. There are fewer competitors in the market. It's going to be tough, many people consider, for Deliveroo to grow to the extent that it would have to, even to justify the valuation that it currently has.
And well, retail investors aren't able to sell their shares just yet. That's going to happen next Wednesday. Should we be expecting another exodus from the share?
I mean, it's unclear exactly what's going to happen. Already, we know that the shares have closed down 26% today. So what was hoped to be the debut of the decade really has left investors very cold. They may well look at the fact that actually, look, these shares have already come down to some extent. And there has been volatility across the tech sector in recent weeks, and that could be viewed as part of this volatility. And also, there is some hope as well that there will be growth prospects because of some of the reasons that I've outlined. However, I do expect that the share price will continue to be volatile. I think there is anxiety about the direction of the share price, and many of those customers who were invited to take part in the IPO snapped up shares. They'll be left with a bit of a bitter taste in their mouth right now, thinking, look, my investment has gone down. But as we know, with other tech offerings that have come on board, the likes of Uber, the likes of Facebook, they've had volatile starts. Some have managed to turn the corner. For example, Facebook, if it held onto those shares, it'd be sitting pretty right now. But certainly there are risks as far as Deliveroo is concerned, not least because of the gig economy model upon which it's founded. So I think that there will be less appetite perhaps than we've seen amongst retail investors for other IPOs since the beginning of the year.
Now, very quickly, looking beyond this company, we've had so many IPOs, well, perhaps not in the UK, but certainly in the US and other markets. Do you think there's a case of these companies just getting drowned out by there just being too much choice for investors?
Well, I do think that is a consideration, and there is a concern about that because, yes, as you say, in the United States particularly, there has been a flood of IPOs recently, particularly in the tech sector. And although certainly during the pandemic, a lot of people, retail investors, built up a significant savings and they've been dipping their toe into the stock market like never before. We've seen many more retail investors getting involved. But I think as the recovery continues, and the pandemic eases to some extent, it's going back to business as usual. People have less time in their hands, less time to be dabbling in the stock market. And I do think as well, though, the fact that there has been volatility within tech stocks, partly linked to the bond sell-off as well, that has reduced appetite for tech stocks really going forward. So that is playing into the issue as well. But I do think, yeah, there has been a slew of IPOs, but in London there hasn't. And that is why this really poor start for Deliveroo has raised some concerns because London was trying to
I'm sorry, we're going to have to wrap it up there. Susannah Streeter there from Hargreaves Landsdown talking about how she expects more volatility for Deliveroo in upcoming trade sessions.